Mid-cap index, which is up or not, it's flat, nothing. 2-point change on the Nifty mid-cap index as a 60,000, 61,000 index. And I think the small-cap index will come up on your screen as well. And that is up a little bit more. Actually, yesterday, the small-cap index was sulking. Everything else was roaring. So maybe a little bit of a pullback there. Otherwise, it's a very flat start. Nifty 50 heat map will come up on your screen, gives you a sense of where we are starting this morning. And then we pick it up in terms of individual names. So it is more down than up. Asian Paints on one end, what Mangalam was talking about just now. And at the other end, you got ONGC, BEL, Eternal, and others. Surabhi.
Okay, so let's take a look at the movers and shakers. Honasa, by the way, is 9% higher. 9%. I mean, really going great guns. It was just open on my screen here. So that's really the stock of the morning for sure. But on the large cap screen, things are a little quiet. We're about 40 points down on the Nifty. So let's figure out what's down. ONGC and BEL from the PSU pack lower. Eternal is down about 0.5%. Remember, IT has had such a phenomenal week so far. So some of that is coming off. A little bit of profit taking. TCS, HCL Tech, Infosys. All these stocks have a tinge of red on them. Bajaj Finance is down another 0.5%. HDFC Bank is down about 0.5%. The Bank Nifty itself is down about 90 points at this juncture. So there's no one major stock that's kind of leading to this decline, but general sense of profit taking. On the upside, it is still Asian Paints, 4% higher, building on those gains. Tata Steel, the other one that's reported good numbers, 2% up there. Actually, even Hindalco is doing pretty okay. So metals are chugging along. Bharti Airtel and ICICI Bank are the other two big stocks that are ensuring that they provide a bit of a counter to the downside thrust on the Nifty. By the way, the mid-cap index is just broken in positive territory now, Nigel.
Well, that's right. You know, the few stocks from the broader markets, I think they deserve special mention. Aether Energy, we told you that, in fact, there's likely to be a large trade. That large trade got cleared out of the way. Post the large trade, the stock, in fact, is zooming up. It's up close to around 4%. Massive volumes in that particular name. Honasa has done quite well, as you already pointed out. A few other names, you know, Cupid. Stock is up 2.5%. The numbers look quite good, and they're sticking by their guidance, top-line guidance, and guiding for even better times to come. Net profit of around 100 crores is what they're talking about. So that's why one of the top volume movers. Grow continues to moving from strength to strength. Was up 30% yesterday, up another 3% today. And since silver prices perked up overnight, you have some traction on Hindustan Zinc as well as Vedanta. The street is hopeful that that demerger ultimately goes through. On the losing end, Kochi Shipyard, Kitex, as well as Ircon. All three of them are losing out. So for starters, Nifty down marginal, 25 points or thereabouts. Breadth of the market, though, is encouraging just in the first few minutes. Let's see how this goes.
Oh, absolutely. And I think there's enough out there, right? So Grow is the #1 volume-led gainer on the index. And I think market cap should be, inching closer to a lakh crore? Not already, right?
No,
I think
84,000 crores. Yeah.
So yesterday, 30% by close, another 3%. It's of course an interesting one. Asian Paints, right? 10% in 2 days, and I think now for the month so far, that is in November, it should be up over 12%. We've got Honasa, which continues to power higher, strong numbers, and large volumes. I mean, more than the price action. Data Patterns is up about 6.5%. Silver Bees making a comeback. Did we see a silver move last night? 4%
yes.
On Silver Bees. Aether Energy, that block out of the way, 5% higher. Yatra was a big mover yesterday. RK Forging, Nazara is up. Universal Cables reported very strong numbers, 14% higher on this one. So you got lots of stuff. Indigo Paints, right? Absolutely bombed out name, but has been moving from about 1,000 rupees in 4 days back to about 1,200, nearly 1,300 now. So Care Ratings is another one, which is up about 7.5%. More of these listed silver ETFs, they're all coming up about 4-5% as we start. Cochin Shipyard is down 4.5%, maybe the #1 volume-led loser across on the NSE right now. Okay, more stocks in a bit, but we've got a very special panel right here in our studios. Vikash Kumar Jain is India strategist and head of India research at CLSA India. We have Nikhil Gupta, India economist at CLSA India as well. Gentlemen, great to have both of you here. So the context, right? The conference is kicking off coming Monday. Coming Monday. It's kicking off coming Monday. So I just want to start with that, Vishal. What are you aiming to do, and what should we expect out of the conference?
So this is likely to be our biggest India conference in terms of participation. We're looking at well over 300 plus investors joining us, nearly 100 plus companies or so. And what we are trying to do is basically what CLSA is known for, that is to offer unrivaled corporate access, as well as look at themes that are making headlines that are important for the markets at this juncture. What are the themes that are important for the markets? We have a lot of AI this time. We have a lot of global macro. We have a lot of Indian macro. We also have things like defense that we look into. Consumption is always a favorite when looking at India. So that's the other thing that we delve into across the various presentation, and a host of senior management CEO tracks which are there. So, and along with that, on the sidelines, a lot of very interesting conversations. That's what we'll offer at the conference.
Nikhil, for you, it's the first CLSA conference. And how's it been so far?
So far, so good. Very excited for this conference.
Yeah.
And as Vikash said, this is going to be the biggest CLSA conference, so I would like to take some share of that.
So markets, macros, right?
Yes.
You think more questions will be markets or macros? Because both are, now of course, the big market question is when will nominal growth pick up?
I think the macros have been quite well behaved in India, and I'm sure you'll talk about that. It's the market that's been a problem. So.
No, but growth, underlying growth has been poor, right? And I think is that the big talking point? When will that start to recover?
In fact, we'd like it to be the big talking point, because that's where India is getting better. Because I think I'll allow Nikhil to talk about it, but that's not where the complaint is. So,
but also, Vikash, you're starting off the conference against a backdrop of a largely positive view on Indian equities, right? Which is interesting. And before we get into the macros, explain to us why you think India can finally start playing catch-up in an otherwise great global equity bull run. We've just been completely singled out, and we know the reasons, right? We don't have AI, we don't have deep tech, valuations were a concern, we were delivering 5-7% earnings. What makes you confident that this is all set to change?
Yeah, I think, so that's the report that we wrote about today. The interesting thing is, if you try and understand, and for someone who's just a domestic investor, it's very difficult to appreciate what kind of a global bull run we've seen. So what we do is we look at the top 25 or so markets. These markets make up about 85% of global market capitalization. 65% of them have made a new high this calendar year. Last time when you had anything more than that was in 2007, when 70% made a new high in a calendar year. India is not one of them, which is very odd, because if you look at India, India is one of the few markets that if you look at this particular century, 25 years, it's made a new high in 19 out of those 25 years, which is the highest for any market. So it's the most consistent performing market. But what changed this year? Yes, some of those things that you mentioned did change. Yes, that should have taken excitement to other markets. However, the underperformance that we have seen in India is the biggest 12-month underperformance we've seen on record. That is versus EM, versus AsiaX, versus the global benchmarks. The reason was India, in the minds of global investors, due to certain events, got relegated. So if you remember, just to kind of jog your memory back, say in February, everybody in the US administration was, India is possibly going to be the first one to
do a deal. Yeah.
Even till April, May.
Yeah.
That got relegated to now. India is the one with the highest tariffs, almost. In fact, higher tariffs than China at this juncture. So, plus you have the geopolitics, which is always a structural risk which can become hot and, because we don't really have the best of the relationship with our neighbors. That is always a thing which can come up as a risk from time to time. It did come up this year. So from that perspective, there's a slew of these negative news flow, which also caused worries around, okay, what will happen to GDP growth? I think, and we had earnings decline. In fact, if you were to track back and look at performance, our worst performance has been in periods where we've seen earnings getting reported. This time, it's not the case. So a lot of all of this is now going to kind of reverse, in my opinion, with the US president already talking more positively. Suddenly, that fear that India-US relationships is kind of going to become really bad, that should reverse. Plus, our earnings growth numbers are doing okay. GDP numbers, of course, Nikhil's going to talk about.
How much are you expecting this year and next year, earnings?
So if we look at consensus, I think, as a strategist, I pay a lot of attention to that. If you look at FY28 over FY26, there's a 16% CAGR over 2 years that is expected. As compared to, if I were to look at that FY27 over FY25, that had gone down to almost 11% or so. So there's a that also puts us better in terms of earnings growth ranks. Only Taiwan, Korea, and 1 or 2 other markets are better than us. So all of those become much better, and headline news flow improves. See, if headline news flow is bad, you don't want to really, your focus on long-term growth reduces. If that starts improving, then the whole long-term growth story can come back.
So headline news flow, basically, India-US trade deal. Trade deal has to happen.
Trade deal along with other macro things which are anyways improving, which I think Nikhil can answer better.
So is there a high probability that India outperforms from here on, and the FI money that's deserted us for the last many, many months, close to a year or so, do you think that comes back?
Yeah, I think, outperforms means that outperforms what? See, I think it is, if this is a global bull market on the theme of AI, it is going to be very difficult to outperform the AI stocks if the bull market continues.
Right.
But selectively outside of that, the kind of underperformance that we have seen, that's pretty stark.
Right.
So versus a few other things, definitely India should start doing better. So from being relegated to right at the bottom, it has reasons to come back kind of at least in the middle.
Can we Nikhil, macros, what's the view? Will growth pick up? Do we have are there enough ingredients?
Yes, so Prashant, if you look at India's macro numbers, and you pointed out
I'm not talking about the macros. I mean, they're all very good reserves. I'm not talking about that. I'm talking about growth, nominal growth. There is enough in the tank for that to start to fire in a more meaningful way.
Okay, I tell you the numbers which we are expecting it to be. For this year, we are expecting nominal growth anywhere between 8.5%. To be precise, 8.4% for this year. And we are expecting it to pick up to somewhere around 9.5% next year. The important thing to note is next year will be the third consecutive year of sub 10% growth. In fact, our forecast for FY28 is also about 9.8, 9.9. So we are broadly saying we will remain sub 10%. Now, that will definitely look much weaker to almost all who have been invested into the market or looked at India's economy for a long time. The question is, or the way I look at it is, we are now a $4 trillion economy, right? We are now the 5th largest economy. So the size actually matters, right? How long can we continue to grow 12 to 14%? We know we have certain expectations and we want our economy to grow at a certain level. But it is just not possible the bigger we become, right? Yeah. Not only that, we also need to understand what is happening globally. If you talk about 1970s, 1980s, 1990s, or even 2000, at least till about 2007, there was this entire globalization wave. Trade used to grow at 1.5x of global GDP growth, right? Then it grew in line with global GDP growth till about 2019. And in the last 5 years, I mean, protectionism as a policy has started becoming more prominent beginning 2008. But post-pandemic, it has actually picked up at a different level. And I think all of that will reflect not only in global GDP growth, but India will also be affected.
Nikhil, will foreigners buy this argument? I mean, we are still a poor country, right? Under $3,000 per capita. At this stage, if you're talking about, okay, let's settle with under 10% nominal growth.
Right.
I mean, that is, it's not the promise that we made.
Promise we made to who?
I mean, all of us.
The world at large.
Okay, right. Okay, so from per capita income perspective, if you look at, let's say if I grow at 9.5% nominal growth, and then a depreciation of 1.5%, let's say, loosely speaking, so 8.5% in nominal terms, and then a population growth of about 1% or so. Actually, it is below 1% now, which means we are going to grow our per capita income in US dollar terms, 7.5%. I don't think it's actually bad. I mean, if you do the calculation, we'll soon, I think by 2014, and please don't hold me to this, I'm just giving you a rough idea of the calculations that we did. By 2040, we will be $10,000 per capita income, and about 2047, which is the centenary.
By when, 10,000?
2040, by the end of next decade. And by 2047, I think with these kind of forecasts, we will be $15,000 to $20,000 per capita income.
You know, before we talk more granular about the market, Vikash, I just want to go back to a point that you made, and that really caught my attention. When you said the geopolitical, risk, premium or whatever you want to call it. Now, the events that happened in April here in India, and we've had an unfortunate incident in Delhi again. So are you saying that that has come in on India as an added factor to watch on a consistent basis? Because that becomes another then issue that one has to contend with while you're trying to map FPI flows. And I mean, have you heard, what is the commentary you've heard from foreign
So what I meant,
this?
let me clarify that, is that, see, the fact that we don't have the most friendly of neighbors is a reality. But if nothing happens for a long time,
then people forget about
that risk.
Yeah.
If something happens, then that risk comes at the forefront.
Yeah.
So amongst a lot of complaints that people had on the market, this became an added complaint. If something like this comes up, then you don't want to think about long-term growth. So all of these things need to subside. And which is, I think, what will happen over the coming weeks and months.
Okay, all right. Nikhil, let me get you into the conversation now. We've got this very, very tepid inflation prints that are coming in there. What do you expect from the RBI in the upcoming December meet?
All right, so our forecast, we still maintain 25 bips rate cut in December, and we expect another 25 bips in February. However, with this 0.3% inflation that came out yesterday for October, I'm sure the noise for a 50 bip rate cut will become louder. I still believe, if you look at the details, we know that it's purely the food inflation. The core inflation has actually inched up last month. And even now, of course, it is much lower than RBI's forecast that they provided us in the last meeting. But even now, we believe that headline inflation will be back to 3.5% to 4% by the first quarter of FY27. So by mid-2026, we'll be back to 4%. Okay. And that is why I believe it's better. It may be possible that they do 50 bips rate cut in December, which is not our base case. But then I believe that would be the end of this rate cut.
But Nikhil, there are some who are arguing, and we were discussing this with Lata just a while back. There is also that counter-argument that if you're looking at roughly ballpark 7% GDP growth this year, then is there a need to move immediately now after having delivered 50 basis points, or would the RBI look at deferring it? And if that is the case, if the RBI decides to be a little conservative, hold their firepower, then the market implications of that, I don't know if that's been factored in.
There will always be factors on both sides of the game, right? So 7%, definitely we are also expecting 6.9% real GDP growth for this year, but this is divided into two halves. The first half till September 1st and second quarter, average growth we are saying will be about 7.8, 7.9. Second half will be about 6%, which makes it around 7% for the full year. So yes, they may want to hold on, but inflation of 0.3%, I mean,
doesn't get better than that.
The only time since 1990s when we have got lower inflation, or less than 1% inflation, was for 3 consecutive months at the turn of the century. That was October, November, December 2000, when we had 0% inflation. Apart from that, we have never seen lower than 1%.
0% inflation is also...
and sorry, one more point.
Over here.
Just one more point. This is first month. We expect inflation to remain below 1% in November as well. So
on a lighter note, I'm just trying to understand, 0% inflation sounds great in discussion. Do you feel that your bills have gone down?
Yeah,
Do you?
You don't see it when you...
I don't think so. I think everything is going up.
When you get your paycheck, you don't see it?
Yes.
Now we're talking.
Disinflation, that's disinflation.
that is what matters for growth perspective.
Okay, let me ask you this other big thing, right, which is AI. I think both of you would... So one from... Nikhil, you start first. In India, right, this big consumption thing, not just here, everywhere. I mean, who is the consumer? Is a white-collar worker, right? And I think you've done some work on this in terms of whether AI... and the market on the question on AI, Vikas, I'll come to you. But do you think it's a risk here in terms of it may not immediately
employment
show
or
employment, income growth, employment? Is there any way to tell at this stage?
Right. So, Prashant, see, AI, of course, is the theme globally at this point in time, and we need to understand it is led at this point in time by the US and China, right? For most of the Western world, if you look at growth, there is another way to look at growth story, which is from labor market perspective. You look at the growth in employment and you look at the growth in productivity. Most of the Western world and China also, they have reached a limit in terms of pushing their employment growth higher. So if they want additional growth, it has to come from productivity. India is not at that development stage. We need still at least 7 to 8 million jobs every year, and employment growth has been the primary driver of growth for India. And for the next decade as well, that is going to be.
Is there a risk that gets disrupted?
That gets, sorry?
Disrupted. That we need that, but you think...
Possibility,
it's a risk.
Because we need to understand the globalized world we are living into. Even if we want to focus more on labor employment growth, companies cannot avoid the competition that they are getting from the competitors outside India. So if someone else is becoming more technologically advanced, because of which they are becoming more efficient, which is making them more competitive, our Indian companies also have to do that. And that puts a risk on if they will be able to grow their employment or jobs at the same rate where we want it to.
Vikas, we had, Naren with us, and he said the biggest risk to India, the question is still AI, but from a market perspective, is not local, but is global, that the AI bubble bursts. Any thoughts at all?
With all due respect to Naren, of course, he knows more about markets than me. But, I would say that, yes, that's not something that we should wish for, because if there is a, burst...
No one is wishing for it, but I mean...
No, I'll tell you, because some arguments are like, I don't want to look at India because it lacks an AI.
Correct.
So some people are feeling that, okay, if the AI story kind of goes down, and that's the point where India comes back. But yes, eventually it might happen. But India is still an expensive market on an absolute multiple basis. If there is a global correction, then multiples will contract. And even India will see the correction. But in general, to kind of, segue into what Nikhil was saying, I have a slightly more optimistic view on AI in India. See, I think what our true strength is a very young population, which what that allows us to do is be great adopters. All of us, we might remember that we hardly had anything called a 3G. It never worked. There was a time, not even 10 years ago, where people like you and me used to struggle to use even 1 GB of data in a month. When 4G came, we leapfrogged. If you look at even something like payments, digital payments, we kind of leapfrogged and caught up. Unless you believe that AI is a completely different animal, and the winners will be the ones who provide the AI service, which did not happen with internet. Which in fact, I would say, even the ones who are providing the 4G service, they are not the biggest of winners. The winners are all the other apps which mushroomed around it, which people could use. So it's really, how do you put that to use? To put that to use, you need early adopters. And that's where I think the Indian population might eventually come in. But all of this is not what people will focus on at this stage of the global bull market. But eventually, I'm not that not that negative, because I can say that we are great adopters, or you can say we are great cloners also, And I think cloning is something which makes a lot of things successful. You don't have to really have all the money to invest and test.
I'm not sure if that is the reason, or maybe the reason is more tactical, that you actually don't have a very negative view on IT. I don't know if you're seeing some shred of evidence that they're coming up with some ingenious idea of using AI better and then, charting the next phase of growth. Because I don't think you're very negative
in fact, I have
IT,
a contra-positive opinion.
Exactly, yeah. So explain that to us.
There are two reasons for that. Number one is, I think this India, don't think of it just a trade thing. But all of these headlines meant that India-US relationship is kind of going down.
Yeah.
If that starts reversing, then that should be positive for IT. And secondly, when people are trying to implement AI adoption, that's where I think even our IT services companies will be used.
They'll fight back.
Used, and they will get their contract. So initially, it could be good for them.
I'll urge both of you to come back. It's,
We've not even started
12, 15 minutes is too less, but that's what we are doing right now.
I'm sure you can carry these conversations with our colleagues during the conference.
We will. And best of luck to both of you for the conference. The fantastic duo from CLSA. Thank you very much for joining us here. Well, it is conference season, and our colleague Nimesh is at the UBS conference, right? And he's got Miki Doshi, country head at UBS, from the sidelines of that conference right now. So let me throw it across to Nimesh. Nimesh, morning.
Morning, Prashant. Yes, it's a conference season, and I'm actually at the UBS conference. It's day 2 for UBS, and joining me now is Miki Doshi. He's the country head for UBS in India. Miki, thank you for joining us. I normally catch you only in Singapore. This time, I'm lucky to have you in India. Straight to the markets, India has been a rank underperformer for the last 12 to 15 months, and all other Asian markets have done really well. What's the mood from the FIs at the conference, and when you think this tide can turn as far as India is concerned?
Nimesh, thanks for having me on this show. You're right, I don't tend to come on TV very often. Last you saw me was at our Asia conference. But this is a big event for us at UBS. This is our second year of the conference after we integrated with Credit Suisse. The turnout's been superb. Like you rightly said, the FI turnout and even domestics have been around. I think the mood is clearly one of wanting to see the opportunity and see what the the investment outlook looks going forward. Yes, you're right. It has been a rank underperformer. China and Korea, as you know, have been clearly beneficiaries of less flows into India or outflows out of India into those markets. Multiple reasons. I think some of the flows have gone into the IPOs. We've had a robust IPO calendar this year. Continue to have one next year. So that's part of the reason why. Secondly, I think Liberation Day obviously wasn't very favorable for us, which I think, again, we're hoping that changes going into 2026 and is positive for us. So yeah, the mood is upbeat. We actually had the ex-deputy governor of the RBI yesterday. Yeah. Again, very supportive. He thinks RBI is going to be out there and supporting the growth in this country. So I think, yeah, it's...
I'll ask you about banking and RBI, stance as well. But you spoke about, Liberation Day, and since then we've actually underperformed.
Yes.
You're having Piyush Goyal at your conference today, though it's virtual. But as a house, what are you expecting in terms of the India-US deal? By when you think it will see the light?
When it will see the light, I don't know. The hope
But
is...
you're hopeful?
Very. Oh, extreme. I think it's in the interest of both countries, actually. We're no longer a country which anybody can neglect, right? I mean, and if you've seen what our Commerce Minister has done in the last, I guess, 18 months, from Switzerland, Luxembourg, to Norway, to UK, to New Zealand, one by one, we're getting our agreements in place with various countries, right? And I think the US is going to be right up there. So am I hopeful? The answer is 100% I'm hopeful.
So what's the base case at UBS? That the 25% extra will go and the base 25 will remain, or even that will be reduced further to sub 20?
We have not actually done, I personally have not taken a view on that. I think at least as first case, the base case should at least be that the top 25% should go.
Okay. Coming to banking, Mickey, you spoke about a deputy governor at your conference. The biggest FDI in the last 1 year has come into the financial space. Never ever we thought of in the last 15-20 years that Etihad Bank will get an access of 60% stake in RBL Bank. It's unheard of, right? What's your sense? You've been a banker for so many years. Right time to open up the banking sector, and you think more deals will come?
So first thing is, I think clearly the financial sector is a proxy to our large population, right? 1.4 billion people, 1.5 billion people. The consumer play in India, if you play it via financials, there's a great way to play it.
Yeah.
India has had some world-class banks. Yes, you're right. Historically, the RBI was quite stringent on allowing foreigners to come in. If they came in, licenses were given, with a certain business plan. Growth was controlled by them. And I think there was no harm in the way we approached it. I think we've had some, ICICIs of the world, HDFCs, Kotaks, would not have happened that easily if you just allow them to come in the manner they may have wanted to. I think going forward, yes, it's a mature market. I think there's need for a synergy between what the global banks can bring to India in terms of products, in terms of the reach, etc. So yeah, I think the time is right, and I can see more of this happening.
Okay.
I think the dialogue which we actually as a house have with a number of jurisdictions where people are keen. If you ask the Japanese, they're keen to expand here. They ask the Koreans, they're looking for opportunities. So yes, there is keenness.
Okay. You briefly spoke about IPO as well as one of the reasons why some bit of FI money has moved from secondary market to the primary market. You've seen so many IPO cycles in the last 20, 25, 30 years. What do you make of the quality of paper that's hitting the market? While there is an argument of valuations very steep for some of those recent listings like Linkard, but what's generally your sense of the IPO paper in India?
So you're absolutely right. There have been multiple cycles and cycles which have not worked out for many corporates or for investors, right? And go back to the Y2K 2000 boom era, where there were a lot of small companies coming to the market. The one thing if you notice now, the size of the IPOs, right, are clearly differentiated from the past.
Yes.
And I've always maintained that it's easier to get a large IPO done than a small IPO done, right? The size of assets which the domestic mutual funds and of course we've always had the global investors coming in, it's huge. So to make a difference in their portfolio, these large IPOs. So I think what we've seen is most of the IPOs clearly at the right valuation have done well, and I continue seeing that. I think we've seen the other advantages. It's no longer just a single economy, or it's across sectors. You're seeing the IPOs coming out. I was just looking at this morning's papers, from defense to education to consumer. You can buy glasses, etc. So I think it's a very varied sector. India is no longer just a 2-3 sector market.
Sure.
And I think it's going to continue. I think you see that in our pipeline too.
Sure. I want to ask more about the UBS, strategy in India and I'm asking you because recently we saw the deal of UBS buying 5% in 360 ONE, and you want to eventually build this wealth business.
Yes.
As a theme, how much bullish you are across the capital market theme, whether it's wealth management or exchanges or brokerages?
Like I said earlier, right? Financial services is clearly perfect for playing the consumer market, right? I think and could be across the whole chain of retail to ultra high net worth in terms of wealth management, in terms of investment banking, in terms of broking, pure corporate banking, right? We've seen how how banks have grown on that side. Extremely bullish. I think, yes, the reason we did this deal or the hallmark of this deal is you're combining the largest wealth manager in the world, the premier wealth manager in the world, with the largest standalone domestic wealth manager, asset manager in India, right? I think it's a win-win for both, providing access to our global clients to come into India with 361. Yeah. And as you're seeing the markets open up for domestics to go overseas and various
so the plan is to stick with 5% in 361, or you want to increase further going forward?
I think it's early days. Okay. We've just got, the marriage was consummated in April. Yeah. Other agreements have just been signed. I think we'd like to see how it plays out. But clearly, I think it's in the interest of both that it grows. I think even when we did the announcement in April, we did say that this is the start of the relationship. So I'm hoping.
Okay, well, that's Mickey Doshi at UBS and talking about the markets, foreign participation, size of IPOs, and of course a bit about sectors as well. Interesting conversation, and we'll put out the whole thing, play out snippets through the course of the day, and of course you can find the full thing online on CNBC-TV18's YouTube page. Well, time for a quick commercial break here. We're going to come back in just a bit from now. The Ashok Leyland management talking to us. We'll have Shenu Agarwal on the other side. Stay tuned.
Welcome back. So the market is absolutely flat as it can be. It's all about individual stocks, really, the headline grabbers. So Asian Paints, for instance, up and about. Honasa, 6% higher. Data patterns, a very, very strong quarter from data patterns, and that stock surging 8% higher. So it's really very granular down to the individual names, and largely the moves are being led by earnings. More on this as we go along. In fact, speaking of earnings, let's put the spotlight on Ashok Leyland now, because the company also reported a pretty strong set of numbers for the quarter gone by. The margin came in at a multi-quarter high. There was healthy volume growth as well, which boosted the top line. We have with us Mr. Shenu Agarwal, MD and CEO at Ashok Leyland, joining in. Mr. Agarwal, thanks so much for taking out the time and being with us. So, the first half has been largely muted and subdued for the CV industry, but it seems that now there are some green shoots. The GST rate cut has been delivered. The festive season seems to have driven up sentiment as well. How confident are you of sustaining a good performance in terms of growth in the second half?
I would say that GST rationalization is really helping the CV industry. For last many quarters, we were saying that, there is all the macroeconomic factors are favoring the CV industry, but why there is not an uptick? We were talking about the replacement demand. We are talking about the aging of the fleets. We are talking about better fleet utilization. So everything was working in favor of the industry. I think this is a moment when that trigger can potentially happen, when customers can come out and start purchasing new trucks and buses. What we have seen in October is definitely very positive. MHCV industry has grown by 7%, which is much better than 0.12, which we were witnessing in H1. And LCV has grown by 15%, which is again much better than -2 or +2, that we were seeing in H1. So I think this is a good sign. And last time when we spoke, I was telling you that other than just a price cut, I think what matters more to the CV industry is that the whole consumption will get a boost because of this GST 2.0 plan. And that is really happening. We are looking at all the numbers every day in newspapers and in media. And, this consumption boost is really driving the demand of the freight. If the demand for the freight increases, irrespective of the price, people will go and will buy more trucks to fulfill that demand. And that is, I think, what should happen in the coming months. If the consumption stays up, which is expected, prices, of course, have gone down, right? And then I think it is a good combination for the CV industry, and we should see a much better H2 than what we have seen in H1 or some of the previous quarters.
Okay, so what sort of makes up very good or a much better? Are you still maintaining a mid-single-digit growth sort of projection, or could it be actually high single digits or even better?
Very early to say. I mean, at the beginning of the year, we were saying mid-single digit for MHCV and maybe slightly better for LCV. I can tell you right now, based on the indications that we are receiving, that I think we'll beat that target handsomely, that estimate handsomely.
Mr. Agarwal, how are things looking on the market share front? After several quarters, you had managed to reach to the levels of about 30%. Is there any uptick from those levels in the heavy commercial vehicle segment?
H1, we are at 31.0 in MHCV. And H1 last year, we were at 30.5. So we have grown about 50 basis points year-on-year basis. But you know that we were quite stuck at 29.5 and 30 for many quarters. And it's very good to see that now we have broken that barrier and we are moving towards 31. We have achieved 31, and therefore now we should try and touch 32 and beyond.
Okay. In the bus segment, you have, quite a few players, and your market share has been, however, still at 40%. So you continue to be very, very large. But if you remember correctly, in the first quarter, the market share had dipped somewhat. There was some demand shift that was noted. So what has the market share trajectory been in Q2? And specifically, if you could talk about the ICV segment.
Yeah, so listen, we are the leader as far as the buses are concerned. Overall bus segment, we are number one, and we are number one by quite a margin. Our market share is still hovering around 39% or so. And I think the number two player is approximately 10% lower than ours, and number three is then further 10% lower. Right, so we have a commanding lead in the bus segment. The area that we wanted to focus within the bus segment is the ICV bus, which is the light and medium duty bus, not the heavy duty bus, because in the heavy duty bus, we had 70-80% market share. But in the light and medium duty, or what we call ICV bus, we had only 15% market share. Now, that is what we were focusing on for last couple of years. And I'm very happy to tell you that there we have achieved market share upwards of 25% now. We don't want to stop there, because ICV bus comprises of 2/3 of the volume of the entire bus industry, right? So volume-wise, it is very, very important that we have grown our market share from 15 to above 25%. Our target is to get to 40% in ICV. So we will continue to focus there and further do things to increase our market share. In MDV buses, in heavy duty buses, it is a fact that we have lost a little bit, but there is nothing concerning. It's just 1.5% that we have lost because of some regional issues, which we are correcting. So I think we are very strong. We are getting more stronger, and definitely will continue to have that leadership position.
Mr. Goel, it's another quarter of bumper growth in exports. In the first quarter, it was nearly 30%. And in Q2, you've done 45%, but still maintaining your FY26 target of between 20 and 25%. So why not, move that number higher? Can we expect an uptick in this target that you put out?
Sometimes, looking at quarters paint abnormal situation. But there would be some quarters where we would be having 30, 40, 45% growth, as we have demonstrated in Q1 and Q2. But see, look at the long term, because this is not a quarterly business really. So 3 years ago, our volume was 8,000. And we said, in 5 to 6 years in the medium run, we want to treble that volume to 25,000. So I think let us look at that trajectory rather than the quarterly trajectory. From 8,000 in about 2.5 years, we have come to 15,000 last year, 15,000 plus. And now we want to go to 18. And then in another couple of years, we want to go to 25, right? So we are running in this medium term, we are running very, very, very good, very fine on our plans. So we are very happy. This year, if we achieve 18, I can tell you that we have all the masala in place to get to 25,000 in next 2 to 3 years.
Okay, all the masala is in place. Got that. Gives us nice little bit of color. Finally, sir, in the last 2-3 years, your focus has been on diversification, and internationally, you've been reducing the truck market share from 60% to now about 50%. Can you give some more details in terms of how you will keep going forward with this diversification strategy?
This has been another strategic lever that we were pursuing for last 2 to 3 years for various reasons. So non-domestic, non-truck market used to be only about 35 to 40% for us, right? And therefore 60% plus market was domestic truck market. Now, a lot of people, it is a fact also that domestic truck market was very cyclical in nature. Every 2-3 years, it will have a upside, and then after 2-3 years, it will have a downside. And therefore, a lot of people were concerned about Ashok Leyland because they thought that we cannot deliver a very consistent performance. Now, this is the 11th or the 12th straight consecutive quarter where we have delivered double-digit EBITDA. And in every of these quarters, we have delivered more EBITDA than the previous quarter YOY basis. Now, the reason for delivering this kind of a performance is that we have really reduced our dependence on domestic truck market, right? And we are very much focused on exports. We are very much focused on parts business. We are very much focused on power solutions, defense, and some other businesses. And we have done really a good job. So domestic truck market, where our dependence was 60 or 61%, has come down to 50% now, right? And that all these non-CV, non-domestic businesses are also margin accretive businesses, which means their margin is much more than the truck margin, right? So I think this whole lever has really helped us in making a company which is much more resilient. You would be surprised to know that our break-even used to be about 6,000 to 7,000 units a month of MHCV trucks. And now we have reduced it to 1,000 to 1,200 units a month, while our monthly sale is 10,000.
Mr. Agarwal, more questions, but out of time, sir. Good luck with the business as you continue to execute. Look forward to more conversations. Stock's doing very well, 4.5% higher. Appreciate it very much here on CNBC-TV18. The market, by the way, is absolutely flat. So blinking red and green, 25,877. Vinay Rajani is with us, Senior Technical and Derivative Analyst at HDFC Securities. Vinay, good morning. Good to have you here. Just your trade from here, it's tricky, right, Vinay? Because you've got the election results tomorrow out of Bihar. For whatever it's worth, maybe, especially for traders more than anything else, I'd like to qualify that. But what would you do? What would you recommend?
Yeah, so good morning. And yes, sector specific bullishness is still continuing. The sector rotation is also going on nicely. Yesterday we saw a breakout in the pharma space. Before that, we saw a movement in the oil and gas and IT stocks. So sector rotation is doing good, and large cap stocks are especially looking good. And as far as Nifty is concerned, by recovering more than 600 points from the lower level, Nifty has retraced more than 61.8% of the entire downward move which we saw from the high of 26,100 to 25,300. So this was a healthy correction, and we have retraced more than 61.8% by crossing 25,800. So this is a good sign which is negating the potential downtrend, and there is a good probability that Nifty would continue to remain in an uptrend, will cross the 26,100 hurdle and ultimately post a new all-time high. So looking good as of now. Sector rotation is going on nicely. Breadth is improving nicely. 2 days are left for the mid-cap, small-cap companies to post their result. But I'm expecting that after result season gets over, or on 15th November, we can see momentum coming back into the mid-cap space as well. So as of now, we are asking our traders in the Nifty to keep a stop loss at 25,700. That was the lower band of the gap which was formed yesterday. So 25,700 is a support. By keeping that stop loss in mind, one can remain long, and we can expect the Nifty to cross 26,100 first, and then we can expect an all-time high about 26,277.
Okay. All right. And individual stocks, any specific trades for now?
Yeah, so as I said, there is a breakout in the pharma sector yesterday. It has broken out from the consolidation which was there. And after from this particular space, I like Lupin. So Lupin has given a nice momentum in yesterday's trade, and follow-up buying can be seen in today's trade as well. So 2048 is a level one can go long for the trading purpose. Stop loss should be kept at 2020. And on the upside, I'm expecting a short-term target at 2100. Second stock I would pick from the metal space. So metal has been into an uptrend. In primary trend of the metal sector has been quite good. And today again we can see a resumption of an uptrend. And SAIL is the stock which I like on the charts. On the positional chart also, it has formed a nice inverted head and shoulder pattern. So SAIL can be traded long for the trading purpose also. 144.50 is a level around which one can go long. I would suggest a trading stop loss at 141. On the upside, I'm expecting a target of 149.
Got that. Thanks very much for that, Vinay. It's good getting those trades for our viewers. Well, we want to talk about Honasa, right? We just seen a complete turn from last quarter. A big negative has become big positive. You look at net earnings and other matrices. Stocks up about 5% off the opening highs, but still looking strong. Mangalam is here with details. Mangalam, morning.
Good morning. So it's a very good set of numbers coming in from Honasa this time around. Second quarter running, the company had about 4 quarters ago undergone this distribution reset. Project Neve is what they had started. And now that's starting to bear fruit. In fact, the revenues are up around 16.5%. The underlying volume growth is 16.7%, which is the fastest that we've seen in the consumer space so far. The EBITDA is a positive 48 crores versus a loss of 31 crores, and that's percolated all the way to the bottom line, which is a profit of 39 crores versus a loss of 18.5 crores as well. But additionally, the company has, adjusted its revenue recognition method for Flipkart. So now they do a net revenue as against the revenue minus cost of services. So if you adjust for that, the revenue growth is actually a lot better. It's up around 22.5% there as well. What took the EBITDA higher was better than expected gross margins, and at the same time, the ad spends leverage also coming by for the company, which were earlier 40% of sales, are now closer to 33.5% of sales, and other expenses are down as well. So all these factors pointing towards the north for Honasa, and the stock already going into numbers was about 28% away from its 52-week high, still a fair distance away from its issue price at 324 rupees as well. So the street likes this performance. In fact, brokerages too have upped their estimates.
Well, I think, Mangalam, real turn, and let's see, hopefully we'll get a chance to speak with the management as well and pose some of these questions, whether the turn that we've seen in the quarter is durable. At the bottom of the screen, there's a flash with regards to IndusInd Bank. The Mumbai EOW is essentially saying there's currently no further inquiry. We are doing no criminal conduct so far. So at the margin, a bit of a positive bump. Stock, by the way, has been running, right? I mean, 3 days back, 2 days back actually, it was at $800. It's moved up 10% in 2 days and this morning included. So there is some action which is definitely underway there. We'll take a break. We are back. Manisha is going to join us with some focus on commodities. What's top of mind coming up in just a bit.
Welcome back. Well, the equity market at the index level is having a quiet session so far, but let's focus on commodities. Remember, Manisha told us earlier that crude made big headlines. It fell quite a bit overnight. Let's see what else is happening. Manisha, fill us in.
Oh, well, it is crude oil prices which have declined quite sharply. I could have spoken about gold and silver, which gained 2 to 4% overnight. But this headline is clearly from crude prices because the decline has been really sharp. We are trading at a 3-week close with the kind of decline that we've seen. And with that, it nicely brings us below $60 a barrel for the WTI prices. And the Brent, which was trading at 65 last week, is trading at just about 62 right now. Well, to begin with, it is about the OPEC meeting. And of course, the broader liquidation of the futures contract. A lot of people seem to be closing their positions way ahead of the holiday season, and that is what seems to be bothering the markets. But yesterday we also had the OPEC report that came in yesterday, and that is those reactions that you're looking at as well. So OPEC says that the supply is expected to exceed demand in third quarter of 2025. It already has done that, and for the next year as well, they're looking at a slight surplus in 2026 also to the tune of 20,000 barrels per day. But interestingly, while the number may be very strong, OPEC earlier has been talking about a supply issue issue, as in a lesser supply. But now they're talking about a surplus supply, and that change in narrative is what is weighing onto the markets there. OPEC also says that they have overall pumped nearly 43.02 million barrels for the day in the month of October, which is lower than what they've done in September, majorly because Kazakhstan pumped lower. But remember, OPEC has increased by nearly 2.9 million barrels per day in sense of production. Not all of that production has come into the market, is the reason OPEC also has increased a very small hike for December and have planned to do nothing for the first quarter of 2026 therein. The IEA report also came in yesterday, and they expect production at 106 million barrels per day next year, while the consumption is expected at 104.1. So that immediately gives you a 2 million barrels per day of a deficit, or rather a higher supply in the year 2026, also weighing onto the market. So production is more and consumption less. The markets also are looking at the U.S. output, which also is on the higher side. The oil output from U.S. is expected to hit a record of 13.59 million barrels per day. And they're also saying that the inventories have continued to increase in U.S. for the last couple of weeks itself. So whether it is about OPEC report, IEA expectations, non-OPEC and U.S., we are looking at production increasing everywhere and consumption clearly not keeping pace with that. Take a look at the data on IEA also put out in sense of supplies and demand expectation. Now, this is the supply glut expectation coming in from various agencies. Mercury has put it at 2 million barrels per day. 4 million of an excess supply is what OPEC, IEA and World Bank have put out. Goldman Sachs report came in last week. 1.6 is what they're putting out, and CIBC puts it at 1.5 to 2.5. So one thing is very clear, that we are looking at anywhere between 1.5 to 4 million barrels per day of an excess supply in crude in next year, and that perhaps could continue to weigh onto the prices. At these current levels, we perhaps see much of that already factored in. Now, this is a way forward for the crude oil prices. EIA, with their report yesterday, suggests that $55 of an average price is what you could be looking at in the next year. And then you have $50 a barrel is what CIBC puts out. 62 to 68, we have World Bank and Citi putting out as well. But it really is within 60s and 50s that most of these banks and brokerages believe that the crude oil prices could be trading within. We also have Bank of America talking about 64, and then at 60 from Morgan Stanley. Within 50s is Goldman Sachs and JP Morgan talking about 55 to 58 of an average for the next prices. So as I said, between 50s and 60s is where perhaps we could be looking at in crude oil prices for the next year.
Okay, all right. Thank you for that. So crude definitely in focus today. Manisha, thanks for all the details. We need to take a quick break. But on the other side, it's our special segment. It's the economy coming up. Lata today speaks with S&P economist Paul Growald and CRISIL economist DK Joshi on the CPI numbers, export package, and the growth stimulus from data center investments.
Welcome to It's the Economy. India's October consumer inflation is obviously the big news at 0.25%. It has raised hopes for a rate cut from Reserve Bank in their upcoming December 5th policy. Very low inflation also means very low deflators for the GDP. And this is likely to give us a 7 to 7.5% real GDP growth for the second quarter. The data will come on November 28. So will the Reserve Bank not cut? Again, the nominal GDP, that is GDP without adjusting for price rise, is likely to remain at a tepid 8 to 8.5. I'm saying tepid because the budget is assuming 10.5 actually. So should this worry us that nominal GDP is low? Separately, on capex, a recent S&P Global report points out that globally, especially in the US, investment has picked up very strongly due to investments in AI and data centers. There are signs of that in India too. For a 360-degree perspective on growth, inflation, capex, I'm joined by Paul Grunwald, the global economist from S&P Global, and DK Joshi, the India economist from CRISIL Ratings. As you all know, S&P and CRISIL are jointly representing ratings in India. Paul and DK, thank you very much indeed for joining us. Well, DK, given the circumstances, I'm going to start with you. This ultra-low inflation number, what does that mean in terms of Reserve Bank action? 1, 2 rate cuts, when?
Well, I think, first of all, inflation has continued to surprise on the lower side. And I think the central bank had to keep revising the inflation forecast down. There could be further revision on that front. So there is a lot of comfort on the inflation front. And even though the core inflation is at 4.3%, if you strip it off the precious metals, then I think it comes to around 2.6%. So clearly, I think there is very little pressure on inflation, whether it is from the food side, which is driving inflation down, or it is from the fuel side, where the Brent is trading lower, and or it is from the core side. So clearly, the landscape is allows you to cut rates. Now the issue is what happens to growth. I mean, so growth is pretty strong right now in real terms. And so that is why the central bank has been holding off. And actually, in effect, I think they also have the CRR cuts, which are continuing. So there is some kind of easing anyway going on, I think, from the liquidity side. So I think in this environment, I think the ample scope for RBI to cut rates, whether they cut or not, I think going by the last two policies, I'll hold my horses.
Okay, yeah, it could go any which way. But DK, would you worry that nominal GDP is very low? Our real GDP looks good because the deflator is low. Is there a growth worry at all?
Well, I think the too low inflation is also, I think, not such a great thing, because what that means is your tax collections will become tepid. And we already seen that tax collections are trailing the target. So I think that is something to be watch out for. That also means that corporate profits, I think the growth is not going to be, even in the top line, is not going to be that great. So I think the too low inflation also has its flip side. So that is why we are targeting around 4%, which is kind of the right kind of inflation for India. So I think and also it will make some of the indicators look not so good, like the fiscal indicators, because the base for that has come down. So the deficit, etc., will look a little worse off, I think, than what was given in the budget.
Let's get the outside view. Paul, good morning. Thank you very much for joining us. What is the outside view? Are economists, I mean, people like you, worried that India's nominal GDP is falling and that's a cause for worry? What's your view of the India growth story?
Yeah, well, as someone who sits in New York, I think the view on India is it continues to be the strongest performer amongst the major emerging markets. Real growth about 6.5%, maybe with some upside risk, as you mentioned. We haven't focused too much on nominal GDP growth, but I would echo DK's comments. I think the concern there would be on fiscal revenue. But I think the overall perception of India right now, the outside view, as you say, is still, I would say, very much positive on balance.
Okay. What about the currency, Paul? Because, the big problem is that it's not current account deficit, but capital deficit that has kept the currency one of the worst performing, or maybe the worst performing major currency in the world. Everybody else has appreciated versus the dollar. We have depreciated by 3.5%. is that a cause for worry?
Yeah, again, you're right on the currencies. We saw some dollar weakness after the election. The dollar's kind of stabilized a bit. India's underperforming, I would say, one of the weaker currencies as we look across the global complex. I think that's maybe something DK can answer, but India macro looks pretty good overall. The currency is a bit weak, but again, we don't see any major concerns on the macro story right now.
Yeah, that's good to hear. And one can say that, inflation, fiscal deficit, growth all look good. But DK, your take, there has been an export package announced. That and possibly announcement of a trade deal sometime soon. We were all expecting it in calendar 2025. Will that mean that the worst is behind the rupee? Or would you still worry that there is a capital deficit? Capital flows are in an outflow mode.
Well, I think if we get a trade deal, and also I think if there is support to the exporting sectors, I think very clearly that is going to boost confidence. And I think confidence is what brings the capital in. I think one of the reasons why rupee underperformed was India is facing the highest level of tariffs, I think among the highest level of tariffs from the US. I think that coming off will definitely bring in some capital flows, because that's the only distinguishing feature between India and other emerging markets, that we are facing a very high tariff level from the US. Other parameters we are doing extremely well. So I think if the tariff uncertainty comes down, I think I would believe that the capital flows will be there. Now it also depends on what happens to the dollar. I think US is also attracting a lot of capital. So if dollar becomes stronger, then I think that will exert a depreciating pressure on the rupee. So on balance, I would say that rupee will be volatile in this volatile global environment, but I don't see a massive depreciation. Actually, our forecast is that it could be at 88 by March 2026.
Okay. Yeah, I mean, one is assuming that once the trade deal is signed, there should be some level of confidence. Paul, I'm very tempted to go on down the currency road, but let me get a word in on this excellent and unusual report that you all have on data centers. What's the central argument? That US and the world is on a capex upcycle? Is that what you're arguing?
Right. Well, I would say over the last 2 quarters, the focus has shifted from downside risks around tariffs to upside risks around data center and investment. You're absolutely right. We started looking at this a couple of months ago. It's very clear that there is a capex boom in the US driven by data centers. That's the data center construction plus the hardware, which is the mainframe and the racks, plus the software. This is contributing to 80% of domestic demand growth. So just think about that for a moment. The US macro story looks a little bit brighter now, but everything outside of data center investment is pretty flat, and the labor market, maybe one sector is adding employment. So this is a real nice fill-up to the US growth story. We're going to focus in the next couple of years on whether these data center investments will pay off in terms of earnings for the hyperscalers. But for the next year or two, we think we've got a big capex boom going to be supporting growth, mainly in the US, but also some spillovers to Asia and Europe for those who are exporting into that data center boom.
You know why your report is a ray of hope, in fact, a very big change to thinking. Until very recently, global economists who came on the channel were worried about global investment because of the uncertainty of the tariff terrain. Where do you invest what when you don't know how it will be priced? You think now we should be worrying more? I mean, we should be thinking about global growth being positive rather than negative at all. If that is the case, then that is another leg up for India growth.
Yeah, well, this is definitely a tailwind to growth, and we would add easier financial conditions and lower oil prices, which our previous segment talked about. But let me kind of underscore the point that outside of data centers, there still is not a lot happening with business investment or with discretionary consumption. So under the new second Trump administration, we still have a very high level of policy uncertainty and unpredictability. So the outlier here, or the exception, is data centers. But again, that's going to be a nice tailwind to growth for the next couple of years.
No, it is a tailwind also in countries like India, because we hear of data center. That also means the power sector has gotten a big leg up. And there is a large number of industries when you look at generation, transmission and distribution. DK, does that give you anything positive on Indian capex?
Well, I think data centers, of course, I mean, those are the newer growing sectors. Actually, we had estimated that the new age sectors, I think, which is the renewables and these kind of things, they will contribute about 40% to the capex over the next couple of years. So I think these are going to be the drivers of capex. So I think, having said that, I think they'll also consume a lot of electricity. So I think so the demand for power is going to go up. So I think, how do we match that and ensure that the electricity prices remain under control, because there is going to be a demand-supply mismatch if the data center hyperscalers actually they really move much faster. So I think there are challenges, but I think it is a positive story for India as well. Although India doesn't directly export to the US data center story, but I think domestically, I think this is going to help. And it's going to create demand for a variety of things as well.
Okay, I should be inviting you all separately on this data center story when we get the full report, but out of time today. Thank you very much, Paul, for whetting our appetite, and DK for giving us a 360-degree perspective on the India growth inflation dynamic. Thanks a lot for joining us. We have to wrap up on Bazaar on that quick note. Chartbusters coming up.